All right. We are live up here in the background on my office TV. I've got Bloomberg News. We are waiting the Fed decision, which really, for all intents and purposes, we expect a 75 basis point rate hike. If we get that at 11 Pacific Standard Time, come up in 3 minutes, the markets aren't going to react much to it. I'll show you guys what I'm looking at as well, which is the fun part of all of this, is watching in real time what mortgage bonds are doing. If you haven't watched the channel, you've never seen me pull up this from my friends at MBS Highway. Shout out to Barry Habib, all my friends at MBS Highway. This is kind of a markets overview. This is showing mortgage bonds on the left, S&P 500 index, and then the 10-year treasury. Quick lesson for those that don't follow this stuff. As the 10-year treasury moves up, generally you see mortgage rates move up. As the mortgage-backed securities move down, like you can see on this chart that spans over the last year, mortgage rates go up. So if you're trying to track what rates are doing, we could look at this 10-year treasury chart. And this is going to kind of show you the trajectory. This is like the last quarter. Let's show the last 6 months of mortgage rates, right? Upward trajectory as the 10-year treasury yield moves up. And this is August, where we saw a little bit of reprieve and rates came back down below 5% for a brief period in time. If you want to see like a 30-year average, I always point people to Mortgage News Daily. They've got a good chart that, is a good national average. I had somebody ask me this earlier too. Like this blue line is Mortgage News Daily, which is up to like 6.47 today. Like, oh, why is Mortgage Bankers Association number lower, 6.25? MBA looks back, and it's a lagging number, so it just is behind. But for all intents and purposes, it's a pretty good indicator of what rate you're going to see with no points being paid. I've got some people that follow the channel that are clients, and they say, hey, Matt, when I talked to you back in June and this said 6.3, you were able to show me a 5.875. So now that it's 6.47, am I at 5.99? If you've got perfect credit, if you've got 25% down, if you check all the boxes that are lower risk to lenders, you're going to see a lower rate. You work with a mortgage broker like Matt, the mortgage guy, powered by You Mortgage, you're going to see a lower interest rate. This is just a national average. This takes into account banks, credit unions, direct lenders, everybody. So sure, your rate could be lower. If you've got a 665 credit score and you're putting down 3% on a conventional loan, you're probably going to have a 7 handle. Right. So know that this is just an average. The rate decision is imminent. We should pull up something here. Let me see if I can pull up. I'll pull up YouTube and we'll try to get Bloomberg live. Man, my computer's laggy. Hopefully. Oh, breaking news. It's going to be. Okay, 75 basis points. We all expected that. Jerome Powell wasn't going to get tough and do one. So now we're watching. Dude, check that out. Look at that. 39 basis points worse, like all of a sudden. Why did rates get so worse so fast? The 10-year treasury's at 3.6. Maybe it's because of the dot plot. I got to get this Bloomberg pulled up so you guys can hear what I'm listening to. Inflation risks and It's the dot plot. It's them talking about the fact that they're going to be continuing to move up rates throughout 2023. That's why we're seeing the market react to it. That's why we're seeing 40 basis point worsening, which 40 basis points is, an eighth of a point in rate, so that 6.47 might go to 6.57, 6.6. Woo! I think this is the one I'm watching over here. They bumped up their unemployment forecast. My computer is not feeling this. Maybe I got to close some windows. I think 60-something% of the respondents on my YouTube poll thought 75 basis points. We had some optimists like me that said, maybe the Fed will do 100. I mean, as much as it will cause pain and is going to cause pain, like it's a necessary evil. Maybe it's the fact that I'm streaming on my TV, streaming on my computer, streaming on Facebook, LinkedIn, and YouTube. That could be the reason why we're a little laggy. Let's turn that guy off.
June, the economy will expand 1.2%
That'll help.
next year, 1.7% in 2024, and reaches a 1.8% potential rate in 2025. Finally, as I mentioned, almost no change to the statement, just 2 words in the opening sentence. Recent indicators point to modest.
You guys hear that?
In spending and production. In June, they said those had softened.
Minor Key, thank you. Ton of numbers to work through there from Minor Key. So let's go through it together. Just open up the summary of economic projections off the back of this. So GDP gets a cut to the forecast. Unemployment gets kicked higher. Inflation gets kicked higher as well. And so does the dot plot in a major way. The market's responding to this, as you might expect. Equities headed south on the S&P 500. Yields heading north, particularly at the front end of the curve. We're at 13 basis points now on a 2-year. Going into the decision, we took out 4%. We're basically on our way to taking out 4.1% right now on a 2-year. As you might expect off the back of that, the dollar is a whole lot stronger. TK, you can take your pick on what currency pair you'd like to see. Let's just pick up on sterling as an example. 112 handle going into tomorrow, 112.50 right now. That currency pair with a 1% move.
I would say the word plunge or greater is probably what you want to see here. In international economics, folks, dollar moves are very small but very important. Maybe only yen at 144.48 is there, but sterling is stunning. Euro even more so, I would say. Just all of these moves and these dialogues change the game for the governor tomorrow with the Bank of England.
4.6 is your dot, Bramo, for 2023.
It matters for markets. What you're seeing is a very hawkish 75 basis point hike, and that is basically forecasting there is more to come, and they are willing to take pain in the economy, and the market is responding.
Yields up to 13 basis points.
Well, there they are.
Let's see if it sticks.
Let's do one more look here at the data. I think it's so important on the fixed income market.
Yes, Zohab. 75 basis point rate increase, which is what the Fed did. The dot plot is them saying what they plan to do the rest of the year into 2023. That Fed funds rate, which is now in the 3s, I think the range will be 3 to 3.25 on the Fed funds rate. With that being, future guidance that they want to get it to 4.6 or 4.8. I haven't looked at it specifically. I just know that that's what I'm hearing. That is what's causing the change in the markets, i.e., 42 basis points down on mortgage-backed securities, which means rates will go up. The 10-year Treasury is up to 3.6 on this Bloomberg that we're watching. The 2-year is like 4.1. So exciting stuff. If I'll probably stick around till 11:30 until we get actual comments from the Fed, because then we'll see even more movement with the markets depending on what they say.
Well, I think obviously we and the Fed are navigating imperfect information. I think what you're seeing today, and I agree with the previous comment, this was a very hawkish 75 with the dots. One thing I would say is dispute any rumors you hear about the demise of forward guidance. The committee's relying a lot on forward guidance to tighten financial conditions. And I think the fog of uncertainty is the nature of the pandemic shock and the policy response and the reopening means that a lot of the traditional models and guideposts aren't really helping. And so I think this is more of a look at the data as it comes in and wait for the inflation data to fall.
These forecasts previously, Richard, it's good to see you, by the way. Yeah, it's been a while. They were called aspirational, fanciful. We've now got an unemployment rate in their forecast at 22 at 4.4 for 23 rather 4.4 for 24 at 4.4%. Do you think they've ripped the Band-Aid off just yet, or are they doing it slowly still?
I wouldn't say it's ripped off. I think that the contrast with where the committee was in March, which was what I've called the immaculate disinflation, with no rise in unemployment, no fall in growth below trend. So I think this is recognizing that, as the chair said, some pain will be part of disinflation. My own personal view is it probably will be more than the rise indicated by the dots, but I think it is acknowledging that the disinflation is going to cause that pain.
So the risk is to higher unemployment, to even higher Federal Reserve rates off the back of this, you think?
Well, we may not need higher Federal Reserve rates because this is a pretty muscular liftoff this year, and I guess another 25 next year as well. And it clearly pushes the funds rate into the high end of the fours. If inflation comes down as the SEP projects, this could well be enough. The challenge, though, there's a lot of inertia inflation, and obviously the labor market is red hot, and so this is going to be challenging. But I think right now the committee has put in place a path for rates that could well make sense, but not without causing the pain that the chair referred to.
I was just going through the trajectory for inflation as it comes down. I wonder if you still think this is aspirational. 5.4 down to 2.8 down to 2.3 this year for core PCE, 4.5 next, 3.1 the year after that, 2.3. Does that sound about right to you? Is that the appropriate time frame to think about getting these numbers down to back towards the twos?
John, what I call the plausible best case scenario is by the end of the year, inflation's running below 3, and I think it'll take some good policy and some good luck to get there. But there's obviously risk that inflation's more inertial than that, and then it takes longer.
By inflation, you mean core inflation.
Yeah.
See, folks, this is important, Lisa. The vice chairman mentions it and just assumes core, while all of our listeners and viewers are assuming the crushing burden of real inflation.
Although real inflation, or CPI headline inflation, has been coming down, and the fear is that the core has continued to go up. Are you concerned that Fed policy doesn't have the same muscular effect on markets, on the economy as it used to, with a lot of it insulated with corporations that have termed out debt?
I think there's an element of that. Milton Friedman, very, very quotable, one of his quotes was, "Monetary policy operates with long and variable lags." I came to think during my time as vice chair that the lags may not be as long as we once thought, because the economy is very financialized. You are correct. The terming out and household balance sheets are in great shape.
I haven't had lenders reprice for the worst yet, Norm, but I promise you, I'm just waiting. I got a couple alerts set on my phone. Reprice for the worst. I would guarantee that it's going to come. What some lenders might do is they might wait until Fed comments or Q&A, right? Like Jerome Powell is going to come out at 11:30. He's got a pre-written script that he's going to talk through, and like, here's what we did, here's what we're thinking, here's the reason behind the dot plot, all that things, and then do Q&A. There's been some really good conversation that comes out of that Q&A. And, as much as people might disagree with some of the things that Jerome Powell's done, like, comes across to me as a super sharp dude. So maybe lenders are going to wait until that conversation, that Q&A, before they start to reprice. Because I would have thought, like, now look at this rebound. Now we're 27 basis points down, or at least that's what it said for a second. Look at, oh my gosh, here we coming back. 10 years coming down. Who's saying what? Oh my gosh, this is fun because it's like real time. Looking at real time volatility. for anybody who's watching this and is like, what the heck do all these numbers mean? Red for mortgage-backed securities, bad. Mean rates are going to get worse. How much worse, do you ask? 25 basis points on this left-hand side of my screen is really not a huge move as far as how much it affects the rate. You probably see the rate move 5 basis points if this goes down to 25. Let me say that in more layman's terms. When we went from 6.42 to 6.47, that's 5 basis points. That is 0.05%, right? 6.42 to 6.47. Everyone get that? 5 basis points. So that's not exact science, right? Like if I told you that every 50 basis points here was an eighth in rate, meaning, if it was 6.25 and then this got 50 basis points worse, then we go to 6.375. Mortgages operate in eighths generally. That would be that. We're having a rebound for some reason, and I don't even know why. Fed sees the path of hikes through 2023. The dot plots seem aggressive. It seems like it's more tightening and it's more hawkish than before, but I think we got to wait for the comments to really get an idea. And to answer your question real quick, Gary, how often do you see banks call loans on subject to agreements? Never. Literally have wrote thousands of loans, have worked with thousands of investors, never seen a note call due. Doesn't mean it can't happen, but my personal experience, never.
Look at the 2023 dispersion.
I don't think I could turn this up. I wish I had louder volume. You guys hear that?
Over 25 basis point movement. Then, 2024 and 25, it just all falls apart. I'm wondering if, given the fact that there are no models for what we're coming out of, that we should put much stock in what the Fed thinks is going to happen next year.
I don't want to pat myself on the back, but literally, like I was just saying, when my buddy Norm was asking about rate adjustments, when I was like, you know what? They might wait to see what happens with the press conference. This is the alert I get from my friends. Volatility, bonds losing ground after Fed 75 basis point rate hike. Could see a turnaround during press conference, though. So that's that. That's why we haven't seen reprices for the worst quite yet. And look at this. Looky. I mean, for a minute, it was 50 basis points worse. And now we're turning around this ship. Stay tuned. Press conference is coming up in 15 minutes.
Times. The Fed had year-end Fed funds at 90 basis points, and now it's gone to 4.4%. That's a major change.
It's an about face at a time when they are saying that forward guidance is dead. It is very not dead. It is so alive. I mean, this is basically them resurrecting.
When they say forward guidance, the Fed actually puts out what's called a dot plot, and they say, here's what we plan for the future. That's why a lot of this stuff isn't going to have huge impacts the day of the Fed rate hike, because we already know it's coming. They've already shown us dot plot. We've got the Fed funds rate at 3 to 3.25. We are trying to get it to 4.4. Like they just said, if you looked back a year ago, they had the dot plot saying the Fed funds rate would be at 0.9. And now they're already at 3 and projecting they're going to have it in the 4s.
Right, thinking about the rest of the world. The Bank of England.
I'll go get a refill on my coffee.
50 basis points, maybe 75. The ECB's done 75 already. The Riksbank, I'm throwing out a small central bank I know, but it's the world's oldest. It's the OG, the original gangster. The Riksbank did 100 basis points, and how's that worked out? I did do that. I can't say that.
It's terrible. Yeah.
How's that worked out for Sweden? 100 basis points. This Fed is so dominant at the moment in this FX market.
I agree. They're central banker to the world. I said that all along. Thank you, Bill Rhodes, for that important idea. Professor Clarity, you had heard Katz at Columbia, and one of the arch Katz was a laureate, Robert Mundell. He founded our foreign exchange analysis. I'm going to take it, Mundell, to Jacob Frenkel, to Rogoff, Opsfeld Rogoff, and now we go to Rudy Dornbush and the rest. How does the dollar fold into your analysis of the optionality that the Fed has, or does strong dollar overcome the choice set that they have where they're squeezed down to limited choices?
Well, I think the dollar accurately reflects they've got a tightening in policy and more on the way. And the interesting thing, Tom, about the dollar is that in some ways movements in the dollar are more relevant for other economies than they are for the U.S. because the U.S. is relatively close. So big moves in the dollar don't really move into U.S. inflation very substantially. There's something that some folks, including Mario Stoll, called a global dollar cycle. I think thus far I've been pleasantly surprised how well the global economy has happened to a really hawkish pivot by the Fed, but obviously something that will need to be followed.
But if you take a blended index, Bloomberg Dollar Index is a good idea, and there's emerging market ones you know better than me. If you take it log, so slope matters, the answer is these are not smooth curves. The reaction function of any central bank, including Fed, take the Thai central bank if you want as well, but the reaction function they have is not linear. There's a point where it's a jump condition or a kink or a change. Are we close to that?
Are we close to that? Well, I think depending on how you interpret today's move, we could be close to
DXY 111.36, yen 144. That's a fiction. I quote yen. Euro dollar 0.9842 on euro dollar.
I think FX markets and other markets, risk markets more generally, are going to be on the hunt for the foreseeable future and trying to sniff out and determine the pause or the ending of the rate hike cycle. And obviously, I think it's way too soon to be doing that, but that hasn't stopped some folks.
Do you want to give us a month and date for next year?
You can have me on the show next year and we'll figure it out.
We're going to wait 12 months.
Let's find out though, because we were talking with Diane Swank a bit ago, several months ago, and she was talking about how the numbers were fanciful, that the Fed projections were not accurately reflecting the reality of what would have to happen.
Financial Fighter. Love the screen name. Was going to answer this for you. Like, have you missed anything yet? The Fed at 11 Pacific Standard Time, so my California time, announced 75 basis point Fed rate hike, which we all expected. They released the dot plot, which basically says, here's what we plan to do in the future. It's always subject to, watching the market, seeing how the economy is doing, like 1,000 different things that Jerome Powell and the Fed will point to on reasons why they might update it. But at least the dot plot kind of shows you their future plans. And that dot plot at first had a bunch of red as far as mortgage-backed securities go. So rates were getting worse, albeit not a humongous move. And so now what we're waiting for is the press conference, which comes at 11:30, where Jerome Powell delivers some pre-written remarks, and then Q&A. And Q&A is where the real spicy stuff is going to be, where we might see some real, market moving type stuff. It looks like the stock market has started to react negatively based on not necessarily the 75 basis point rate hike, because that was already baked in, right? It's more of an impact is what the dot plot shows. It's kind of like, the Fed is showing you their hand for all intents and purposes. All right, let's see what they got saying over here.
As Rich already noted, with the increase of rates 125 basis points by the end of this year, that's what we expected. We were on an outlier on that, and then an additional 25 basis points next year. That is a lot of rate hikes, and I think we're going to see some non-linearity to that. I do think that the strong dollar is more a problem abroad, but we don't know what kinds of sins ultra low rates have papered over in recent years, and that's where I worry about what are we going to see revealed as rates go up higher and in a a more dramatic fashion. It's non-linear. Rich, you got the floor.
Hi Diane, I would simply say that if you go back and just look at past U.S. downturns, even in mild recessions, 1960, for example, which I was around for, although 3 years old, the unemployment rate goes up by 1.5%. So even in a mild recession, a rise in the unemployment rate of less than a point would be actually quite unusual. So if you think it's going to take some form of recession to disinflate this economy, then I think probably yes, something closer to 1.5 rise in the unemployment rate is more consistent with that.
This is a delicate question, but John has mentioned this quite a bit. Hold on. It's a delicate issue right now because we're talking about rising unemployment from a very low rate.
Yes.
But it's going to become an increasingly politicized issue. We're already hearing today in the hearings, the bank hearings in Washington, D.C., some of the Congress members pushing back, saying the Fed's going to torpedo momentum. How does the Fed respond to a politicized issue at a time when nobody wants to see anyone lose their jobs?
Of course, and I think that's why the Jackson Hole speech was so important because using the phrase, the Fed's going to keep at it, recognizing that there would be some pain, and also the chair and other members of the committee have been quite effective at saying, history shows that in the long run you can't get and keep maximum employment if you don't have price stability. So I think the way that the committee will address that is to say that we need to get inflation down. We will get inflation down. And over the long haul, that'll be the best way to maximize employment. So I think that will be the way to answer that.
We're 9 minutes away from the news conference with Chairman Powell. If you're just tuning in on TV and radio, 75 basis point hike from the Federal Reserve. The forecasts are absolutely fascinating. If you want to pick up on one thing, the dot plot, aggressively higher compared to where we were at the start of the year and even just a number of months ago. Your equity market down off the back of it by 0.6% on the S&P. On the NASDAQ, we're down 0.7%. The poison, as we've talked about it all week, it's at the front end of the yield curve, up 10 basis points, 4.07% on a 2-year yield. Yields up, dollar stronger, sterling weaker, 112 handle on cable. Remarkable stuff. The dollar index up another 1%, a 111 handle, Tom, on the dollar index, a 111 handle.
Absolutely fascinating. And I go to foreign exchange just as the deepest market here, and yen is maybe not where it should be, but everything else, John, has moved to the point where it's a reset on the screen that we've rarely seen in 18 years.
So how does the conversation change from here? We've had that aggressive shift in the plot. Connor Sen of Bloomberg Opinion handles Victor wrote this. Just allow me to read this one out loud. Will the 23 dots move up in December, March, or will the 24, 25 cuts be pulled forward? Is that going to be the new market debate now? Rich Clarity, your thoughts on that? What's the risk here? The 23 dots have to be pushed up, or those cuts in late 24 into 25 have to come in?
I think that both in terms of economics and in terms of what they communicated, the committee is going to really need to push back against this idea that they'll do all the heavy lifting this year to get the rates up, and then immediately at the first sign of a slowdown in the economy, which is part of the plan, that they would cut rates. And it was striking to me coming out of the July meeting how some of the more dovish members of the committee pushed back against that. And I would imagine the chair will have an opportunity in 8 minutes. He'll get that question. But yes, I think, in terms of market pricing, I think markets will continue to romance.
Am I behind here by 2 minutes?
Than it is to actually do it than it is to say it. But the reality is we take a mild recession inflation now because we know the mistakes of the past. That doesn't mean the Fed won't make a whole new set of mistakes, which is what I'm worried about. But the flip side is if we allow inflation, this inertial inflation that's proven to be more sticky,
inertial inflation,
get entrenched, you have to take a much deeper, scarring recession later on to eradicate it. Right. And the back-to-back recessions were really bad in the early 1980s, and that's what they're trying to avoid, those mistakes. Now, like I said,
all right, layman's terms for anybody watching about like avoiding the double dip recession of the 80s and inertial inflation, like we need to get inflation under control. And to do so, the Fed has talked about in the past, like it's going to cause more unemployment. They're Fed tightening, raising interest rates. It's bad for companies. It's bad for employment. We'll see higher unemployment. But if they don't do that and get things under control, it's going to be a bigger disaster later. So I think that's, Steve, from transitionary inflation, like, it's just transitionary. Now it's inertial, right? Now it's got like some inertia behind it. So we got to get it under control. But whatever the case, like that's a true statement that the Fed, and that's why anybody who's following it is like, just rip the Band-Aid off. Do 100 bips today. Do 125, right? Like all this, like incremental stuff is just kind of like a slow bleed, right? Like rates are going up and you know, it's getting harder on companies and it's pushing up mortgage rates to the, you know, slow down demand. You know, housing has a big push on that core inflation rate, right? Like, and really want to slow that down, really want to get inflation under control, like it might take drastic measures. But, you know, they seem to be doing it while it appears to be pretty aggressive, 375 basis point rate hikes in a row. To get to where they're trying to go is going to take a lot. We'll have to see, Andrew. This is a great question. Like, could they be raising too much instead of pausing and seeing what happens? I think in Q4, when I had that call with Barry Habib last week, and we talked about like the month over month inflation readings. Last summer's readings were really low. So when we get June, July, and August, and even September, like it's going to look like core inflation isn't coming down because it's low, but it's also was low last summer. So year over year is not going to look that impressive if we're talking about how much can we pull down core inflation. But October, November, December, and then the first 3 months of this year, those month over month readings are huge. So we're going to see inflation come down, no doubt, in the fourth quarter. Core inflation is going to drop. And yeah, maybe there's not enough time to see what these rate hikes really do to inflation, Andrew. But that would lead me to think that if they continue doing what they're doing, and I think they will because they've dot plotted it, they talked about it, they're already on this path. If they overcorrect, then in 2023, they might lower the Fed funds rate. That would be opposite effect on the mortgage rates, mortgage-backed securities. You know, rates would come down. I think a lot of folks are expecting that. And then probably be a good thing for the stock market as well because that's correlated. All right, let's see what they're saying.
Elements to the picture right now, but I guess if there is a wild card, it's probably a rate hike cycle impinging somewhere globally that's not obvious right now.
Our currency, your problem, seems to be the focus at the moment.
John Connolly.
When does it become our problem here in America for this Fed specifically?
Well, it obviously becomes a problem if it becomes systemic globally and leads to a sharp global downturn and all the consequent elements of that. And of course, everyone's hiking. Almost everyone's hiking now, except Mr. Kuroda in Japan. So we've got a global hiking cycle. Remember, in the last cycle, the ECB never got to zero, let alone off negative. So this is a different dynamic, and that just elevates the risk.
Just the fan on what's about to happen here. Does the chairman have a smartphone in front of him with the S&P 500, the Nasdaq on?
I don't. Not
yet.
I know of.
Moving.
Not that I know of. When we had our meetings in person, the meeting would end, and then the chair would prepare. But I don't think so.
Tom, do you think that would help the chairman if you could see what the Nasdaq was doing on decision day?
He's on Greenspan. Greenspan would really care. Greenspan really cared about Chapter 23 and Name Your Basic textbook, and he really cared about financial markets and markets. I haven't seen that from Jerome Powell.
Because this equity market is ripped in these new conferences. I tell you what, the way it works around this is that Lisa often looks over at me and looks at the equity market and says, what's happening here?
Yeah.
I do not get this.
Yeah, well, and that's, I think, the question that I would have for him is right now, is he happy to see the market reacting the way it is?
I'm going to vamp off of Richard Clarida and say, to me, he is central banker to the world. I think of Ecuador, 1998, and on. You can go back. I'm sorry, he is the central banker of the international community in this press conference.
The international community is not too pleased with it.
Wait till you see Pacific Rim open. I looked at ADXDY, and we're down 2 standard deviations.
You talk about rewriting speeches, Governor Bailey, and the Bank of England decision tomorrow.
And John, seriously, with great respect for what you and I witnessed in London, are they an emerging market?
Tom, the currency's traded that way on several occasions. I would say at this point it's going to be very, very difficult for a rate hike to gain any traction, given what this dollar's been up to. Chairman Powell's walked into the room. He's going to start this news conference any second from now. Your equity market is lower, yields are higher, your dollar is a whole lot stronger. Here is the chairman of the Federal Reserve after a 75 basis point rate hike.
Good afternoon.
Here he is.
And I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. With Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments.
That's going to be negative. Running off the balance sheet. That's going to be negative for rates.
High growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Q&A now. Let's hear it. This will be interesting.
Hi, Chair Powell. Thank you for taking our question. Gina Smiley from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The LMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of of reducing.
What's up, two guys?
We want to be very confident that inflation is moving back down to 2% before we would consider that.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates? Or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. And the way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was...
Is there a point in time you can see pausing? Is it linear? Raising rates, or is there...
Oh, I'm sorry.
I should know better than to not talk with my microphone.
I know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly, today we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly, in my view and the view of the committee, there's a ways to go.
Hi, Chair Powell. Rachel Siegel from Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things starting to get better, and we do see some evidence of the beginnings of that. It's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors it will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, a rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession.
Real quick, here's our watch on mortgage-backed securities at a zero, basically unchanged mortgage rates today.
Down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding what the labor market is.
Nick Cameron to the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive, and by that I mean is meaningful. Putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think. And you see this this is something we talked about today in the meeting.
Agreed, you guys.
In all of our meetings. And you see this, I think, in the committee forecast. You want to be in a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, measure those against some sort of forward-looking assessment of inflation expectations. I think you would see, at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on this. You say it's meeting by meeting, but it sure looks like we're going to 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is going to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. Well, that's how we think about it.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Will
Is not
conditions in
close.
the housing market affect that decision?
I think a number of things might affect that decision. But the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy, international spillovers, and it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us, and vice versa. The forecast that we put together, that our staff puts together, and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about, the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it. It's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you, our contact is more or less ongoing.
All right, I got a 12 o'clock, so I'm going to record kind of my recap, my thoughts on this, and I'll publish that video tomorrow on YouTube. In closing, with Jerome Powell kind of leaving the door open for pulling back, I think that was a positive for mortgage interest rates. As you can see, like, we're green now, 14 basis points better, which isn't a ton, right? Like, you're not going to see a big movement in rates. You might not even see a reprice for the better with many lenders. It just seems to be pretty flat. But interesting nonetheless. I'll give my full take. I got to jump to a 12 o'clock because I do run a business. And so I have to get back to running that. Thanks to everyone who joined. Appreciate you. You want to connect with me and my team, greatmortgagebroker.com. Until next time, we gonna see. I've always done non-QM, Corey. All day, every day. DSCR, bank statement loans. We do them. All right. Take care, guys. Bye-bye.